Alright everybody, Stocks by the Numbers, welcome back. Today is Thursday, it's about 2 p.m. here. We have a couple of companies reporting earnings today after the close, so I wanted to do one of my patented earnings prediction videos here. Again, this is just my opinion, just giving a quick overview of a couple of names reporting, and let's see if we can potentially call most or even all of these correct. So first company we're looking at is Nike Incorporated, ticker symbol NKE, listed here on the New York Stock Exchange. This stock right now trading at 101.5. It's up about 1.25 point. 1.25% here on the day. And last time I made a decent call on this stock. Yeah, it was right around here. I called out this potential rising wedge here. I was looking for a pullback to around this level. And you can see the stock obviously dropped down, chunking down, came all the way down here. This was going into October. And if you remember, October, markets were still selling off, even into November, but this stock ended up climbing even though they missed revenue. And as you can see, the stock was down here at sub 90 and was taken up to $124 again after missing on revenue. Then what happens? Earnings come out, the company misses on revenue again, and boom, drops down, gives it all back. So since then, we've kind of been in this downward consolidating channel right here. And in my opinion, if earnings are a beat, then chances are it'll jump up at least a couple of points right there, back up to over 105.5, and could potentially maybe get up here to around maybe like 108-ish, 109, 110. So I'm not exactly sure, of course, what's going to happen. However, I will say this estimate right here on this revenue, 12.28 billion, is lower year over year. So they are expecting Nike to report a little less revenue. I know if we read a couple of these recent headlines, they're citing potential increased competition, and they're also saying that I saw one analyst saying that what did he say? He said that they were focusing on where they were selling more, in his opinion, as opposed to what they were actually selling. So potentially raising concerns about, products in the pipeline potentially coming out. But let's see here. There was something. Here we go. Nike's third quarter earnings preview, why analysts are, quote, incrementally cautious short term. Okay. 12.28 billion. Company reported revenue of 12.39 billion in last year's third quarter, and again, they just missed revenue for the last 2 or 3 quarters in a row, whatever it was. So the company does seem to be slightly struggling here, which is why, in my opinion, of course, it's a brand name stock, right? Nike. I'm sure we're all familiar with it. And of course, we know that, in my opinion, if you really want to play it safe when you're doing an earnings play, you could always do a straddle. You can buy some calls, some puts. That way, whether they beat or they miss, maybe you can make yourself a couple of bucks. But in my opinion, I have to say right out of the gate, I would probably say puts again. And again, past performance doesn't dictate future results, and I'm not really trying to pat myself on the back, but in the past, I believe I made like 1 or 2 decent calls on Nike, both on earnings and just general analysis, just looking at the technicals, calling it out in the Discord for some people. Again, Discord, link in the description of every video, free for you guys to join. But I have a feeling that they miss. And as you see here, the estimated revenue would mark the lowest quarterly total from the apparel company since the fourth quarter of 22. Nike has beaten revenue estimates from analysts in 7 of the last 10 quarters, but missed the last 2 straight quarters. So that's why, in my opinion, if they're slowly losing market share, I don't know if we could necessarily chalk it up to a boycott, maybe, perhaps. I don't know. I know a lot of people were upset back in the day. I'm not really honestly sure if that's still going on. But in my opinion, I just think that, again, as I mentioned in a previous video talking about VF Corporation, I just feel like that there is much more increased competition now for these older brand name companies in the space. And I just think that consumers, again, are looking for value products, unfortunately. And when we're talking about Nike, I know some of these price tags could be pretty expensive, depending on what you're looking at. And that's why I'm saying, in my opinion, I just think slightly losing, and again, it's not necessarily losing market share. I mean, technically it is, but it's more in the immediate short term. right? We're not saying these consumers will never buy Nike products again. What we're saying is that in this current environment, it may be just a little bit higher on the price tag than what they may be able to spend themselves. So they may be looking for different avenues of footwear and apparel. You know, they do stuff other than sneakers. But yeah, missing on revenue the last 2 straight quarters. So as of the short term, not looking too hot for Nike. And again, 12.39 this time last year. Now we're expecting 12.28. So in my opinion, I would probably lean towards puts here on NKE. Analysts expect Nike to report their quarter EPS of 74 cents compared to 79 cents in last year's third quarter. Nike beaten EPS estimates 9 of the last 10 quarters. So the profitability, as we see, isn't really the problem. It's been the recent drop in revenue for Nike that's been the problem. Now, let's see what this analyst says. Quote, while we remain long-term optimistic, right? What did I just say? While we remain long-term optimistic on NKE due to their long track record of success, we've become incrementally cautious short-term due to a frustrating lack of product innovation. There's a Wedbush analyst. Analyst has an outperform rating still on the stock, lowered price target from 131 to 115. Nike's consumer direct acceleration could have been a mistake. They focused too much on where they were selling. Yeah, this was the article. They were focused too much on where they were selling and lost focus on what they were selling. Analysts said competitors have been able to come in and, quote, chip away at Nike's dominance. This includes the Nike-dominated basketball segment, he said, where it has seen more competitors gaining momentum. Expressed optimism around some new products coming from Nike that he said could turn sentiment around. Quote, investor sentiment is quite low now, and Nike has a long track record of proving doubters wrong. Top line growth is needed from Nike for shares to take off, says the analyst at Truist. Quote, we continue to believe that the stock will remain range-bound until there is a clearer sign of sight into stronger, consistent top-line growth. Analyst has a hold rating with a 111 price target. And as you see here, you have a couple of companies, Lulu, Deck. Lulu also reporting today. We'll take a look. But yeah, Decker's obviously been on fire. We recently did a video. I spoke about that one a long time ago, saying it was a nice, steady, slow grower, in my opinion. You know, much more expensive per share compared to some other stocks we were looking at. But, you know, sometimes you get what you pay for. But at the end of the day, like I always say, in my opinion, follow the revenue, follow the growth, follow the solid companies. And something like Deck, I believe up almost a double from when we originally looked at it and got added to the S&P along with SMCI not too long ago. Bank of America remaining neutral, lowered their price target from 125 to 120. Telsey outperformed, lower price target from 140 to 120. That's a big drop. Citi maintaining a buy, lowered price target from 135 to 125. See, that's what I mean. It's like that, you know, you can't exact. This is why I appreciate what they're saying, because you can't really bet against the company in the long term because it's such a big brand name in the space. And even if they struggle for a couple of quarters or a year and a half, chances are they should be able to get back on track and make any adjustments that they need to make. So that's why, again, in the long term, I kind of agree with most of these analysts, and I appreciate the fact that everyone's still optimistic in the long term. Here in the short term, though, again, we can see that the company has been missing on revenue for the last couple of quarters. And also now we're seeing year-over-year declines potentially in sales, talking about potentially losing market share to companies like Deckers and Lulu. So this is why I'm saying, I think, in my opinion, right here in the short term, I would lean more towards puts on NKE. But again, you know, if you want to play it safe, if you want to straddle, try to play both sides of the fence, it's entirely your own prerogative. RBC, maintaining outperform, lowered price target from 120 to 110. Morgan Stanley maintains overweight, lowered price target from 125 to 124. Okay, thanks for coming. But again, in my opinion, I just think that they're struggling here in the short term. New products will likely will be a key topic for analysts and investors when it comes to Nike's reporting. Guidance the company previously led 2024. Several new products, believe it or not, another topic. Sports endorsements, lost Tiger Woods. Company's pipeline. Upcoming Summer Olympics, Euro 24, Copa America 24. So, again, in the long term, obviously could be good. Here in the immediate short term, I would probably lean towards puts again, to reiterate. Market cap 154 billion. We have a PE of about 29 and change. Again, the EPS side has not been a problem. The company has been growing their profitability side and coming in above estimates 3 of the last 4 quarters. Revenue, as you see, 13.3 down to 12.3, 12.8, 12.9, back up to 13.3. That was Q4. That was technically an increase year over year. And now we're going again, Q3, 12.38, and we're expecting a decline, 12.28. So this is why I really do have a feeling that I really do have a feeling that this is going to be a put play. But last time we looked at Nike overall, you know, fundamentally, the stock really doesn't look too bad. Obviously, the company's been around for a very long time. They've been growing very nicely. And as you see, even just a couple of years ago here, the company was doing 10 billion and change. Now we're sitting here 12, 13 billion. So the growth cannot be denied. And again, they are a pretty profitable stock, as you see here. Going back to the last 8 quarters, you can see we had 1 miss on the EPS side. And again, revenue was looking pretty stable, minus the last 2 quarters as well. On the annual side, more consistent to the upside than the downside here with the positivity. As you see, going back to 2015, the company missed on annual revenue only twice in the last 8 years. And on the profitability side, we missed 3 times in the last 8 years. But again, in my opinion, I really don't think the EPS could be the red flag here. Even if the company comes in line or slightly misses on the EPS, I really don't think, in my opinion, that's what's going to beat the stock up. I think it's this revenue number. I think this revenue number right here, showing a decrease year over year, if they even meet this number, in my opinion, I personally would view that as a red flag. And of course, if they miss this number, then that's why I'm saying, in my opinion, probably down to 90. Even if we stay range bound, as that analyst was saying, if we stay in this downward consolidated channel, then coming to the bottom of the channel here would be just above 96, maybe 96 and a quarter. And then chances are you can see a little bump and then a drop back down to this fib, reapproaching the bottom trend line here again. So in my opinion, I would say 95. I would say 95 is my personal price target. And of course, depending on what the company actually says, if they do happen to miss on revenue and then forecast weaker results moving forward for next quarter as well, then you could potentially see, this is a 1-year chart, by the way, then you could potentially see the bottom fib level here, 92.12. Let's see what it looks like on stock charts, and then we'll move on to the next company. Got about 3 names I wanted to look at real quick. But again, this was a miss on revenue here. And look at that explosion. This is why I always say, in my opinion, these random market pumps are very, very dangerous, in my opinion. We have an RSI here on the daily, middle of the road here at 50. Again, we're in this downward consolidated zone. 50-day moving average 102.07. The company hit almost 102 today and looked like it rejected when it got up there. So still have a little less than 2 hours to go. So of course it could rally right, you know, in the last 30, 60 minutes going into these earnings. But we'll have to see where it closes. But again, it's more about the numbers that come out, really, not really looking at moving averages or anything right here, in my opinion. But it has been climbing the last couple of days with earnings coming up, in my opinion. That probably helped them out. And we had the MACD slightly cross to the upside there, so that's keeping it up, in my opinion. But I still lean towards puts. I still lean towards puts. But again, it's just my opinion. Since 2024, the stock has been down pretty big. We've seen multiple rejections here off the mid-Bollinger Band, and now we drop down. And what was I saying over here? Yeah, down to 96, this fib 95.54, this bottom Bollinger Band 94.52. Okay, not exactly lining up, but that could be potentially the range where the stock does pull back potentially if they miss. Maybe that 94, 95 range. Let's check the pivot points very quickly. On the weekly, yeah, we have a point right here, 108.47. As you see, we dropped below that point basically when the ball dropped, and we've been down below that level since then. Let's check the daily very quickly. Okay, 99.16. You can see it broke in the beginning of March. Got back above, rejected off the moving average, retested that level, and then has bounced since then and been up basically all week. Next up, 103. Yeah, in my opinion, if they do beat this resistance level up here at about 107.5 would technically be above that top trend line of this downward consolidation zone. So that would potentially break it out of the zone. And then after that, you could potentially see about 111.5 up here at the next resistance level. Of course, that's if they beat earnings. If they miss, though, again, you can see, look, we're down here again in the 94.95 level, 94.76. So that's why I'm saying, in my opinion, I personally, just me, I am leaning more towards a miss, and I would lean towards puts. But again, if you want, you can straddle, be safe. If you agree, disagree, let me know down in the comments section below. Next company we are looking at is Lululemon. Stock has been on a tear over the years. Ticker symbol LULU, listed here on the NASDAQ. Stock's up to $477.77, up about 8.5 points still right now, about 1.8% here on the day. And this company has been doing very, very well. I really cannot lie here. Apparently, yoga pants are now taking over the world, and everyone wants them. And we have a market cap here. We'll call it 63 billion. PE could be viewed potentially as a little high here at 60. Again, this is a retail stock, and we know that these apparel stocks have been, for the most part, been getting beaten up and been getting kept down. But Lulu has been delivering and is showing very, very nice growth year over year. So, again, as I say, follow the numbers. And in my opinion, if they're consistently coming in above estimates and beefing up guidance moving forward, forecasting continued growth over the next 1, 2, 3 years, then obviously the stock will consistently be up. The one thing that I'm looking at here is this massive jump in EPS. And I appreciate the fact that Q4 looks like their biggest, most profitable quarter, and that's fine. But as you see, this time last year, the company posts $4.40 a share on estimates of $4.26. Now estimates are $5 a share. That is a massive, massive jump, in my opinion, on the EPS side. The revenue, 3.193, is also a pretty big jump as well. But I think, in my opinion, the EPS number may come in short, and because the stock has been up so much for so long here, you know, just look at this, going back. Look at that rage here going in 2017, 2018 since then. Stock down here at $50. Now we're at almost $500. So we've almost 10x'd over the last, 6, 7 years. And granted, it may very well be deserved. But I just think, in my opinion, these estimates may be too high. And here you can see Q4 of last year, $2.77 billion. And now the estimates are $3.193 billion. That is a big percentage jump, both on the EPS side and on the revenue side. So again, not knocking the company at all, because they've been doing great over the years. But I just think that these estimates may just be a little too high. And I think that because the stock has been up so much, I just think that any slight miss or negative catalyst that comes out could be the reason as to why the stock takes a smack. And in my opinion, again, beefed up revenue, beefed up EPS estimates. In my opinion, I actually think I would consider puts here on this company. But overall, again, the company itself, if we're talking about a long-term investment, has been doing very well. Look at this growth here over the last 5 years. About $3.25 billion up to almost $4, up 10% basically at $4.4 billion. Then the revenue jumps up almost 50%, $6.25 billion. Then we're above $8.1 billion. And now to close out 2023, I believe estimates for the fiscal year are like $9.3 billion or something like that. So the company, it looks like the company's still going to post over $9 billion. I'm just not sure if they're going to hit that fiscal year number. Could also make the potential argument that we ran up here, potentially posting with the flag, but I don't know if I would really look at it like that, in my opinion. $2 billion, 0.22, so that would be 4.2 billion, and then that would be 6.6 billion. And then if they post this number, you're looking at almost 9.8 billion, which I believe is above expectations here. Let's look. 9.6 billion. Yeah. So it's looking like they could beat that number, in my opinion, if they're able to come in above expectations on the revenue side. But again, $5 a share on 3.19 billion. I mean, this is a big jump. However, I will say, look at Q4 in 21, 2.13 billion, and then look at Q4 of last year, 2.77 billion. So this company, it really is amazing me. It's amazing to me, in my opinion, because they're literally showing like 20-30% growth year over year. It's amazing. But 3.19 billion, in my opinion, again, something like this, I just feel like it is risky, of course, if we're talking about, just buying naked options, calls, puts on an earnings play. We know it's 100% a gamble. But in my opinion, even though it is risky, I feel like the reward to the downside could be pretty big if this one does happen to miss and you position yourself in some puts here, in my opinion. Almost reminding me of Celsius. Remember when I did that video about Celsius Holdings, CELH? The energy drink stock, right? They were consistently growing and beating estimates as well, and the stock was flying to the moon. And I made the argument, in my opinion, that it was very overvalued in the numbers, and there was probably like an 80-90% chance that they were going to beat earnings again. But I made a quick little short-term trade idea video saying that, yes, even though it is risky and you're betting against, a consistently growing stock here, and you're probably going to be wrong, if they do happen to report any negativity, because it's been up so much, the stock could potentially go down so much. So playing the puts, again, aim small, miss small, but at the same time, if it worked out, you would have made a phenomenal percentage return. Now, obviously, fast forward, that didn't happen. They beat earnings, the stock went up instead of down, but I'm sure you can appreciate what I'm saying. That's why sometimes... again, we know it's a risk, but sometimes it does pay occasionally to swim against the stream and be the nail that's sticking out. And yes, you may get hammered, but at the same time, you may clean up like a bandit while everyone's sitting there very confused and very upset that it didn't just keep going higher. So, sometimes it pays to swim against the stream and, play the side that most aren't playing. But again, based on the consistency, I mean, if Lulu happens to come out and beat on the top and bottom line here, I mean, it would be very impressive. But in my opinion, I really wouldn't be shocked either, because they have been pretty consistent, as we see. Looking at revenue over the last 8 quarters, they've only missed one time, and it was the slightest miss that we can see. Since then, they've been beating. On the annual side, again, we had one slight miss for the year in 21, and then we came back and came about 1% above analyst expectation for fiscal year 22. So 23, again, looks like they could potentially be in line or maybe even above this 961 billion mark for 23, but it is a big quarter. So in my opinion, I don't know. I would consider leaning towards puts here on Lulu as well. But also at the same time, right, we looked at Nike before and we said Lulu could potentially be taking market share. So if Nike takes a hit and misses on estimates, then you can make the argument that someone like Lulu will probably beat on earnings estimates and see, an increased jump in revenue. So it would be hard to tell, but in my opinion, I do know that these apparel stocks, these footwear companies, these retail stocks have been kept down and beaten up, most of them anyway, for the most part. But Lulu's been doing very well, but in my opinion, I would consider puts here. The annual side on the EPS, you can see, again, less than a 1% miss back in 2016. Going back to 2015, that was the only slight miss here. Look at the growth and profitability as well. Climbing over $2, basically $2 a share year over year here. 12.5, 14.25, 16.4, 18.25. And the revenue is forecasted to continue growing as well. After 23 wraps up, the company's looking for almost $11 billion in revenue for 24, and then 12 1/3 for 25, 13.6 for 26. So they're forecasting consistent, steady revenue and profitability growth for the foreseeable future. And in my opinion, it could very well happen. Again, I just think that $5 a share on $319 billion, I just think these numbers may be a little too high, and the stock may be ready for a little bit of a pullback. The cash, we're holding about $1 billion cash on hand. Debt up to $1.17 billion as of last quarter, was slightly higher than that, but basically consistently increasing, it seems, over the last several quarters. Free cash flow took a little bit of a hit here quarter over quarter. But we see, again, Q4 of last year, the company had very nice free cash flow. Ended up with $1.15 billion in cash. So they could beat these estimates. They could blow them out of the water. But again, in my opinion, I would maybe lean more towards puts. But that's just me. We have assets outweighing liabilities. That's why, in general, the company looks pretty decent. Okay, gross profit. Operating expenses basically staying in line. Operating income. Check assets. Assets consistently growing. Liabilities growing as well, but assets are outpacing them. We can see equity consistently maintaining or stepping up here quarter over quarter. Book value about 18 months ago was under 21. Now we're sitting here at almost $28 a share book value. However, the stock's up here at $478 a share. So we are trading at a pretty high price to book ratio. Again, PE sitting here at 60. We can see going back the last several quarters, that's the highest it's been. Price to sales about 6.5. Going back the last several quarters, that's the highest it's been since the beginning of 22. Price to cash flow, okay, has pulled back, sitting here at about 30, was much higher. Price to book, again, sitting here at about 17 times book. That's the highest it's been since back here again, Q1 of 22. Right, enterprise value right now currently sitting at 61.67. Again, enterprise value, what another company would value and be willing to pay for this stock. You can see that's actually below the current market cap. But also, as of last quarter and all the quarters before, this number was between 40 and 50 billion. And we have a market cap here of 60 plus billion. Again, not really one of the leading indicators, in my opinion, to look at. However, very interesting. Our return percentages, yeah, not the lowest it's been, however, has been declining over the last couple of quarters. Same thing with equity. Return on invested capital also was 30 plus. Now we're down here in the low 20s. Gross margin up here at 57. Technically down quarter over quarter, but for the most part up higher than where it was about a year ago, right? These last couple of quarters, you can see 57, 58, 57. Back here, we were 54, 56, sub 56, 55. So we're slowly inching up on the gross margin percentage. In my opinion, that's a green flag. Operating margin does bounce around from high teens to mid to low 20s, but is maintaining that 20 mark. EBITDA, same thing, holding that 20 plus mark throughout all these quarters. Very nice. Net margin, again, we had one rough quarter, but other than that, we've been maintaining double digits. Technically, this is, though, the lowest it's been going back the last several quarters, minus that one big drop. Inventory turnover up here above 3, slowly stepping down the last couple of quarters in a row. Asset turnover, though, again, how much revenue the company is able to generate off of assets on its balance sheet. As you see, that is consistently stepping up here. You had the slight dip here from 166 down to 162, but now it's being maintained. So that's why I'm saying fundamentally, in my opinion, I personally, I'm not seeing anything wrong with this stock, if you will. But again, we could potentially make the argument that a couple of those metrics are down from where they were. We're trading at a very high price to book ratio, in my opinion. But the business is growing very nicely. So almost similar to Nike. Well, actually not really similar to Nike, because Nike's been struggling on the revenue side the last couple of quarters. But similar longer term outlook, where I'm saying that, in my opinion, Lulu stock in general will probably continue to climb and probably, continue to grow as a business, and in the long term should be fine. Here in the immediate short term, though, again, estimates of $5 a share on the EPS side, almost 3.2 billion jump up here in the revenue side. I just think it might be a little too high, so it might be worth it to roll the dice and maybe grab some puts here on Lulu going into earnings. Looking at the pivot points here, 483.31. We hit almost 481. Recently got above the 50-day moving average. But yeah, in my opinion, you could potentially see like a 10-15% drop here with how long the stock has been up and how much it's been climbing. So you really could see a pullback here to the 420s potentially. If they beat, chances are they'll probably bring it up here to about 500 a share. But you can see we had the big run up here after the market rally, and then we've been in this downward consolidating channel, and now it looks like it just recently popped up. But again, we have earnings coming out, so I don't know if we can really chalk it up as a technical breakout, in my opinion. MACD has been steadily climbing. Let's check the weekly points. 438.09. What did we hit here, out of curiosity? 440 and a quarter. Okay. So didn't really retest that mark. But again, you can see here the low 400s. Looking at the weekly, that's where the 50-day moving average is, just below 415. So that's why I'm saying, in my opinion, we could see a very nice chunk down, maybe 10-15%. And I know it's a little bit more of an expensive stock that a lot of you may not be looking to play at all, but again, in my opinion, with these steady climbers, sometimes it pays to swim against the stream because people aren't expecting something negative to happen. And I'm sure the call side is much heavier than the put side, right? So if you can swim against the stream, buy a put for cheaper because people aren't expecting it to happen, then the company happens to miss those pumped up estimates, boom, stock chunks down to the low 400s. All of a sudden, your options probably printing like crazy. But here on the weekly, we can see we've been staying right at that mid-Bollinger Band and steadily climbing up and bouncing off of it and climbing here for the last several weeks. So that's why on the technical, fundamental and technical side, in my opinion, it does look good. But just specifically talking about earnings here, I would again lean towards puts, in my opinion. RSI up here 61. MACD drop down, potentially curling now. 418 potential pullback. We can see on the daily we're at the top Bollinger Band here. 477.47. We're technically still slightly above, but yeah, in my opinion, maybe a pullback there to, the 420s or the high 14s. Yeah, good stock overall, but in my opinion, I would swim against the stream. In my eyes, I would roll the dice. Here we're looking at FedEx now. Ticker symbol FDX, listed here on the New York Stock Exchange. FedEx right now, 263.85 cents, up almost 4 points, about 1.5% on the day. FedEx, what I'm noticing is FedEx actually has a lot of debt on their balance sheet. We have a market cap 66 billion, PE down here at 15. Company is very profitable, though, even though we're seeing the profitability slowly stepping down, and they missed last quarter as well, and now estimates are even lower here, 343. Last quarter, they posted 399. This time last year, they posted 341, above estimates of 271. So now these estimates are basically what they reported this time last year. However, if we're seeing profitability step down, then in my opinion, they may miss this 343 number and actually post somewhere in the 330s. So we could potentially see a miss on the EPS side there. On the revenue side, 21.95 billion on the revenue side, and we're seeing that we're actually slowly stepping down here quarter over quarter. Last quarter here, you can see from Q1 to Q2, we went from 21.68 back up to that 22 plus billion mark. But we were down 4 quarters in a row before having that slight bump, and the net margin dropped as well from about 5% down to 4% on that bump up in revenue. So as of right now, in my opinion, the company may be struggling just slightly here in the short term. 90 billion for 22. Check the forecast out of curiosity. Yeah, everyone's pretty pumped about it. We have 31 analysts covering the stock, 15 giving it a strong buy, 6 giving it a buy, 10 saying to hold. We have no sell ratings. Price targets all over the place here, as low as 195, as high as 337. On the EPS side, the company has beaten more times than missed here, 5 beats in the last 8 quarters. On the annual side, the company has not missed on the EPS side going back to 2015. So that's why I'm saying, in my opinion, the profitability is not an issue. As you see here, the revenue has been the issue on this stock. And we can see going back the last 8 quarters, this company has missed on revenue 7 straight quarters in a row, 7 of the last 8 quarters. And now I feel with this dipping down to sub 22. Yep, last time estimates were 22.7. They posted 22.2. And then the year before they slightly beat, but that's basically that was the last of the positivity, it seems like, and they've been missing since then. So, in my opinion, again, anything can happen, and because they've been missing, maybe some people would play to the upside, but I don't know. Based on all of these recent quarters, I mean, I would probably lean more towards the put side, to be honest. Since 2020, the company was doing very well up until 2020, beating on fiscal year revenue estimates for 6 years in a row. And then we can see for 21 and 22, missing less than 1%, not a huge miss, but technically missing for the last 2 years in a row. And you can see revenue for 23 expected to drop again. So now we went from 93.5 down to 90. Now we're down to sub 90. Looking to rebound moving forward into 24 and 25, but if this trend continues, then probably that future guidance may be potentially lowered. And that's why I'm saying, even with these lower estimates here, the company may beat, but they may warn of potential volatility or negativity moving forward, or they may, again, guidance moving forward, they may lower the profitability side, or they may lower the range of the revenue expectations for the next quarter or the next fiscal year. So that's why, in my opinion, I think it's just in a situation now where almost any negativity could help bring the stock down. The dividend, though, the dividend was chunked up very nicely here coming out of 2020. They were maintaining $2.60 a share. Then you can see for 21 up to $3 a share. For 22 up to $4.60 a share. So that's about a 50% increase year over year going into 22. But again, if the company's struggling and consistently missing on revenue expectations, I'm not exactly sure if they'll be able to consistently keep upping that dividend. And we can see from 18 going into 19, the debt more than doubled, going from $17.5 billion up to north of 36. Staying above 36, going into 21, we're at 37, we're at 38 and a third now. Let's switch over quarterly. 38, 38.09, 38 and a third, 38.2, 38.18. All right, so it's slightly been stepping down, but again, if you're consistently missing on estimates, you're probably not going to be able to take care of that debt. Again, this debt right now, look at this number here, $38 billion. That is more than half of the current market cap of the company. However, the company is holding right now, as you see, several billions of dollars in cash on hand. We have positive free cash flow. As you see here, negative 340 up to almost a billion. 1.69 billion. I'm looking here. The mid-bar free cash flow, 169 billion. Down to sub 1 billion, down to 469. However, they went positive for Q2, and at that time last year, they were negative 340 on cash flow. We have about 50% more cash on hand than we did back at that time. Assets outweighing liabilities. Equity has jumped up above 26 billion the last couple of quarters. Book value really bouncing around here from the 90s down into the 70s, then back up to 100 plus. Now we're back into the 80s. So this company is swinging around a lot. But yeah, I don't know. In my opinion, you're telling me you missed on revenue the last 7 quarters in a row, And I feel like every time we run it up after the big drop and miss on earnings, we run it up, we try to rebound it, everyone thinks it's undervalued, and then the company reports earnings and they miss, and we bring it back down. And then we find the bottom, we rally it back up into next earnings, and then the company reports and they miss, and we bring it back down. So that's why, again, in my opinion, I understand it's been climbing a little bit. It's up over 1% here on the day going into these earnings, but based on performance that we've been seeing, again, in my opinion, I would probably lean more towards the put side as opposed to the call side. PE sitting here at 15.4, not the highest it's been, basically in line. It's been holding 15 most of the time. Price to sales up here at 0.75. That's actually the highest it's been going back the last several quarters. Price to cash flow 6.76. Not the highest it's been, but above its average of the high fives for the most part before that. Price to book trading a little over 3. Before this, as you see, on average was holding in the 2s. Now we're up in the 3s. So we could make the argument, looking at that metric, that we could potentially have a pullback here. Okay, our return percentages are actually up. These are the highest they've been going back the last 7 or 8 quarters. That's a good sign, in my opinion. Gross margin maintaining that 20+% mark. Okay. Operating margin down here 6.4. Yeah, been bouncing around. I mean, I guess it's basically in the average zone, but we can see we were up to 8% and we've been consistently stepping down now for the last couple of quarters in a row. So we could potentially see now this quarter having the operating margin potentially drop back into the 5% range. So that's why I'm saying, in my opinion, I just feel like the negatives are outweighing the positives here with FedEx. And I know it sounds like I'm being very pessimistic today looking at these 3 stocks, but in my opinion, I think I would go puts, honestly, across the board. Again, Nike, NKE, Lululemon, LULU, and FedEx FDX. I really think I would go puts across the board. That margin percentage up slightly, was down here in the mid 3 range, high 3 range, jumped up to 7, still maintaining above 4. Technically dropped the last couple of quarters though. Inventory turnover was up here above 120, has been consistently dropping quarter over quarter. Asset turnover as well, how much revenue the company's generating off of its assets, as you see, was slightly climbing up to 113, has been consistently stepping down here now quarter over quarter for the last several quarters. Debt ratios seem in line. Debt to equity ratio down slightly. Long-term debt to equity down slightly. But you can see FedEx Express segment took about a $3 billion hit there from 21 to 22. Freight is up. Look at that jump, man. It just amazes me how just in the last couple of years, because of that nonsense that we dealt with here in the States, all of these prices have exploded for all of these companies, and they're all miraculously making 40, 50% more revenue year over year than where they were prior to 2020. Just breaks my heart, but it is what it is. You had a big jump internationally from 25 to 28.5 billion, then drop back down to that 25 billion mark. Let's check stock charts very quickly. I'll let you go. FDX. Okay, we're up here, top Bollinger Band. We've been climbing, but again, markets have been up consistently here for reasons, in my opinion, unbeknownst to me. Again, everyone supposedly was pumped for the last 6 months about cooling inflation. Inflation comes out hotter than expected. That's technically bad news. It doesn't matter. We go higher. Everyone's telling me I'm on the wrong side of the fence for the last 6 months. They're going to cut rates. They're going to cut rates. You hear it every time there's a Fed meeting. Oh, we're expecting a rate cut. We're expecting a rate cut. And then they come out and consistently say that they're not cutting rates and keeping them where they are, but yet markets explode and go higher anyway. So in my opinion, to quote the late great George Carlin, it's all bullshit, folks. It's all bullshit, and it's bad for you. And the only reason why I keep talking about the market pumps is because, number one, first of all, it takes good companies and brings them too high. So we get to these unrealistic valuations, and in my opinion, you can't buy it for a good or fair value. On the flip side, it also takes very crappy companies, and it rewards them. Again, the rally in FedEx, as they were consistently missing on revenue, and then they miss, so we chunk it down. And then it's consolidating, but then throughout March, it started raging again. And, now potentially they're going to miss, and we're going to maybe bring it back down. So this is why I always say, if it's a justified rally, then it is what it is. GDP's up, unemployment's down, right? Okay, fine, great, okay. Good news. But, you're trying to make it seem like I'm not understanding the situation when, in my eyes, this situation does not make sense. And again, just to remind everyone, not to get political, but just a quick reminder, someone like Donald Trump was one of the better presidents in regards to the stock market. One of the better presidents since they were saying Reagan, right? 40 years ago, back in the 80s. Then you bring in Joe Biden, who essentially seemingly looks like he's trying to do everything the opposite of what Trump did. And yet somehow we're up the same or more than under Trump. You understand what I'm saying? So this is why I keep raising these concerns, because in my opinion, I really do believe this is not real, authentic stock market growth. I think that we're starting to see the beginning of that supposed reverse market crash. And we are actually chunking up and climbing these 10, 20, 30% in values on our major indices because our dollar has potentially dropped 20, 30% in buying power and in overall value. That's my opinion. That's the way I'm looking at it. So that's why, again, if you want to make that argument, okay, I kind of understand. On the flip side, if you want to try to make the argument, oh no, everything's great, we deserve to be up this high, I'm sorry, respectfully, I have to disagree. But looking at FedEx here, sorry, I went off on a tangent, but we can see RSI now above 70. But again, people are pumped here going into earnings. We're above the top Bollinger Band, 260, 260. In my opinion, I think it breaks down. It comes back into the mid-range here, the low 240s, and potentially even back here to like the 230s and the 220s, depending on what the company reports. But the MACD has been rising nicely over about the last 4 or 5 weeks straight. And that's why it's been up so much after being down and consistently missing earnings, and it may see exactly what we saw this time last quarter, and we run it up and could potentially tank it right back down. Here we can see the stock has been climbing nicely over the last several weeks. It is above the mid-Bollinger Band, tried to retest, looks like it bounced up towards the upside. Yeah, in my opinion, I still expect a pullback here. Bottom Bollinger Band, 230 and change, 200-day moving average on the weekly, 226.21. Yes, the MACD just crossed to the upside, but it took, again, a massive market rally and optimism on these earnings coming out to do all that. So, in my opinion, I think, again, I think they miss on revenue, and I think it curls and goes back down and may even drop, again, maybe 220, 210. It really depends. It really depends on what they report. But RSI middle of the road for the most part, 59.5. I don't know. In my opinion, based on what we're seeing, I wouldn't be a buyer here. So Nike, NKE, LULU, LU, and now we have FedEx FDX. In my opinion, puts across the board. And I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky and volatile and very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. Best of luck to you.